All right. Well, thank you again for everyone who's able to join us here today. My name is Holly Mazzocca. I'm the president of Bartlett Wealth Management, and I am thrilled to be here today with Jason Katz. Jason is an advisor on our team. He is a specialist who works very closely with many of our business owner clients. Jason is a certified financial planner, a certified exit planning advisor, and he's also a certified public accountant. So internally, we just like to say that Jason's a bit of an overachiever, which is a great person to have on your team when you're really digging into the complexities of what it means to run a business and how it affects your personal wealth. Today, our webinar will cover 5 questions that come up time and time again. We're going to explore it through a very interactive case study. So throughout today's conversation, we invite you to utilize the chat function down at the bottom of your Zoom webinar screen to share your questions along the way. We'll incorporate them throughout and then leave plenty of time at the end for additional questions from our audience. And the goal here is to really understand and see how these questions impact your personal wealth. And those 5 questions that we'll cover today are: number one, what does it mean to be ready to sell your business? And how could some of the unexpected things in life, like divorce or disability, potentially affect your plans as a business owner? Our second question will dig into: what is the right level of risk in my portfolio investments outside of my business? Is there such a thing as de-risking too much? Number 3, we'll dig into gifting. So, is it possible for me to gift some or all of my business to either other family members or charity? And what will that mean for my personal goals and our family goals? Our fourth question we'll dig into is diversification. Have I diversified my asset base enough to provide flexibility in my future plans? And number 5, we'll look at exit options. What exit options will best align with my goals and our family's goals? So before we dive into today's case study, we have some exciting updates at Bartlett that we wanted to share. Recently, Bartlett was named on the Barron's Top 100 Registered Investment Advisory Firms for 2024. We came in at number 49, which is very exciting in this nationwide list. And this ranking really touches every department of our firm. It's not just our advisors or our client relationship associates, but it's our operations team, our technology teams, our HR teams. And it's really amazing to see the commitment of the entire organization of Bartlett coming together to serve our clients. We also wanted to draw your attention to an exciting event we have coming up very soon, our annual strategy update. Jason and I will be back again on that one, joined by some other colleagues at Bartlett to share our thoughts on the year ahead. This year's strategy update, our theme is a grounded perspective. So with all the change going on in the world around us, how do we maintain this grounded perspective and approach to help serve our clients? We'll have live events in Cincinnati, Louisville, and Chicago. So we invite you to scan the QR code or look down in the chat, and our colleague will be including a link down in the chat where you can register. We also do have a webinar option for the strategy update as well. So we'd love to see you there for our next event. As a reminder, as we go through today's conversation, continue to use the Q&A function down below to input your questions. Use the chat function for anything that you'd like to share as well. So with that, let's get back into business owner services, and we'll take a look here at Bartlett's business owner services process. And today's conversation is really going to center around the middle of that process, steps 2 through 4. So assessing the business, understanding what are the risks inside the business, what could happen if we have to sell at different times, adding that into your personal financial plan, and then looking ahead at what comes next and incorporating that entire aspect into your financial plan. So, with that, we're going to bring Jason on here next, and he is going to introduce you to our sample clients, our examples for today's conversation in our case study, James and Hannah Washington. Jason, I'll turn it over to you.
All right. Thanks, Holly. Yeah, as Holly said, we're going to introduce you to James and Hannah Washington. We thought that the best way to explore each of these questions is actually to use a case study. So on your screen, you see some basic information for James and Hannah. They're both 55 years old. We have them living until age 95. They have 2 kids who are married and 2 grandkids. And we'll go through some of the questions that we're going to address, or those will be important. The next thing we're going to look at is their net worth statement. So if you look on the screen, you'll see that they have some emergency funds, a brokerage account, a couple IRAs, and then you'll see the large asset, which is their business, Cornerstone Enterprises. So James is the 100% owner of Cornerstone. As you can see, it's worth about $6 million. Each year, its EBITDA is about $1 million a year. And of that $1 million, the business distributes about $700,000 to James and Hannah each year to cover their expenses. You'll also see that they do have a beach house and a home, total net worth in the $11 million range. In our analysis, we don't actually sell the beach house or the home in this scenario. So the basic takeaway here is that they have the business, and then they have about $2 million outside of the business. And we'll see how that affects the plan going forward. The other thing that I'll mention is that within their investment accounts, their asset allocation is about 70% stocks and 30% bonds. And so the rate of return that we assume going forward is we want to be very conservative in that rate of return assumption when we run these financial plans. And for them, it's about 6.4% is what we're assuming on a 70-30 portfolio. And so we'll see how that affects the plan as well. If we want to look at the next thing we'll look at real quickly is the expenses that they pay. So we said that they bring in about $700,000 from the business, and their basic core expenses are about $300,000 a year. And then on top of that, there's some insurance premiums that they pay, as well as their income taxes. And we'll see on the next screen, we're going to look at what does their cash flow look like over time. So what we're doing here is we're really building out a base case together. So this is what James and Hannah's base plan looks like. And what you're seeing is some inflows from the business, that $700,000 growing a little modestly over time. And then there's their outflows, expenses, insurance premiums, taxes. You'll see that in 2024 and 2025, they actually are netting about $100,000. And then in 2026, 27, 28, it doesn't look as good. What's the difference? The line there is their income taxes. So this is a little bit of a plug for the strategy update, but this has to do with the sunset of the Tax Cuts and Jobs Act that is slated to happen in 2026. James and Hannah own a pass-through entity, and if nothing changes in Congress, that could drastically affect their business income and the tax on that business income. So I mentioned that, but that is also layered into the analysis. So what does this all mean? So let's take a look at their portfolio assets over a long period of time. So if we pull up the lifetime portfolio value, you'll see that James and Hannah, they start with that $2 million of portfolio assets, and it grows modestly over time at that 6%. And then you'll see that big spike in values in 2034. So this is when they sell Cornerstone Enterprises. So we've assumed that 10 years from now, they sell Cornerstone for about 11.7 million. So current value 6, they sell it for close to 12. It's actually a pretty modest growth rate over a 10-year period. It might seem like a lot, but a nice exit for them. They pay taxes on that, and then it grows over time.
So, Jason, this is a linear projection. So, just assuming that the markets chug along at a reasonable rate over time, which anyone who is in this business knows that's not exactly how the markets work. Is there a way of analyzing this that takes risk into account and really demonstrates the potential variability of returns?
Yeah, so one thing that we like to do in these things is look at it in terms of a stress test. So the concept here is called a Monte Carlo simulation. We're actually running the plan 1,000 different times with 1,000 different market scenarios. So some of those years are really bad bear markets, some of them are bull markets. So we'll show you here what when we run the analysis, what does an average market look like in terms of what this could look like over time. It's not going to be so linear up and to the right, but you see that there's some years where things are going really well and other years that it doesn't. But at the end of the day, on the far right, that this number at the far right represents the amount of portfolio assets that the Washingtons have at the end at age 95 to pass on to their heirs. So that number is kind of right in the middle of your screen there, $20.5 million. That's a future value number, but it's still a significant number, and a 95% probability of success. So we'll take a look at the Monte Carlo summary here next that kind of summarizes all of this data in terms of what does their financial plan really look like? What is the health of this? And you'll see the main numbers that you see here is 95% success, which means that when we ran their plan 1,000 different times, 95% of those, they had enough assets to achieve all of their goals, pay all of their expenses, income taxes, and some other goals that we've layered in. This, as a reminder, does include the sale in 2034. And the portfolio assets at the bottom there, we like to look at the median of those to say 20.5 million is the amount of portfolio assets left at age 95. So we would describe this type of plan as very solid, a very solid plan. We know what we're going to do. We're going to sell this business in 10 years. We're going to get the price that we want and move forward. So this was kind of our base case. And we're going to explore a couple of different scenarios here on what could affect your base case.
So let's jump into that first question, Jason. What if the Washingtons are forced to sell the business today?
Yeah. So how could that happen, right? What are the couple of things that could happen? You really focus on what we call the 5 Ds. So the 5 Ds are death, divorce, disability, disagreement, and distress. Each of those has each of their challenges. But the idea here is that one of those 5 Ds can happen to the Washingtons. And so you don't always get to choose when you sell your business. So one thing that we will want to look at is, we have this sale 10 years from now. What if the Washingtons had to sell that business today? So what this is doing is putting that sale today, and you'll see that the probability of success of the plan goes down to 34%. This is one of those that's in the red, right? We're not excited about this financial plan result. And why? I mean, you're selling it today. So we have it being sold today at today's value, $6 million. That's a lot of money. But what you're missing is the 10 years of really great cash flow into their plan, and it makes a significant difference. So, you know, what are their options at this point?
Yeah.
What are the things that they can do? So maybe they decide that, hey, instead of spending $300,000 a year, that their living expenses can go down to maybe 225,000. So maybe they're forced to do that. Maybe they choose to do that. But the idea here is that they actually have to spend less in order for their plan to be successful. So,
So Jason, what's the bottom line takeaway for our first question here?
yeah, so the bottom line is that it's really to try to always be ready to sell at any point. So, what does that really mean? So, there's some basic kind of core concepts of having clean financials, right? Knowing exactly what's on your balance sheet, income statement, what's flowing through the business. Are there any personal expenses in there? Things like that, things that a potential buyer might look at negatively. There's also things like customer concentration and vendor concentration. Do you have all of your sales tied to very few customers? Or all of your supplies come from very few vendors? These are risks to the business. And also comes to mind things like buy-sell agreements. Do you have
Mm.
the proper agreements in place in case one of these 5 Ds happen? So whether it's a partnership that you're in and a disagreement happens, is that in the operating agreement? Is there a buy-sell agreement in place? Just making sure that you're ready, because these are kind of those projects that get put off till later. Oh, we'll handle that later. We'll deal with that later. Uh, we want to bring to your attention that sometimes we don't always get to choose when we transition the business.
These are the projects I think of that are very important, but not urgent. And as a business owner, we know that the fire drills end up always sort of taking precedence. So how can you carve out some meaningful time to work on these types of items just to make sure that there's that backup plan in place should the cash flow not be there for the next coming years and a sale is forced sooner than what anyone really expects or would have hoped for. Let's take a look at our second question. So our second question today has to do about risk. And what we sometimes hear from our clients who have been owning and operating a business is they've already taken the risk. They've had a tremendous amount of risk invested in their business. And when they get to that point of having that exit event, they say, that's it. I can't do it anymore. We need to de-risk our investment portfolio. Is there such a thing as de-risking too much? And how does the amount of investment risk in a plan impact the long-term results?
Yeah, that's a great question. I think what you were talking about, there's really two types of risk, and two different ways to think about risk, right? There's the ability to take risk and then the willingness. And so you were kind of touching on the willingness piece.
Mhm.
We do see that from clients where it's like, hey, I've taken the risk. I wanna hone it in. I want to make sure that that we don't take too much risk, or I am risk averse now. But then there's the idea of the ability to take risk, and that's where we need the financial plan to tell us that. So let's take a look at a scenario where, as you're seeing on your screen, this is the base case. We're back to the normal. We sold it in selling the business in 2034 at the 11.7 million, the 95% success rate. We're good. This is the portfolio that is invested in the current scenario. In the base case is 70% stocks and 30% bonds. But what if, instead of reinvesting at 70% stocks and 30% bonds, what if we did the reverse of that? What if we did 30% stocks and 70% bonds? And you'll see, well, Jason, is that your big finish? That didn't really do much. Well, yeah, it actually, the success rate goes up, right? You're taking less risk in the portfolio. And so, yeah, more of the trials, more of these financial plans that we're running are successful because you're kind of bringing the guardrails in. But then if you notice in the bottom right, what is our median ending value? It's 13.5 million. So before it was 20.5 million, now to 13.5 million. Some of you may say, I'm completely fine with that. I'm okay with that. And it's a good point. It's part of what your goals and values are. It's part of your willingness to take risk. But the one thing that we might want to think about is kind of the what ifs and how de-risking can maybe reduce a little bit of flexibility in your plan.
I think flexibility is a really important word there. So, now the Washingtons are no longer spending all the time in the business. It's 2034. They decide we want to travel more. We have big charitable plans. We want to gift a family. And what happens if those expenses go up a little bit more than where they were when they were spending all of their time working in the business?
Yeah, so as a reminder, in the current plan, it's $300,000 of kind of base living expenses. So what happens? Let's look at the scenario where they have to spend or they want to spend 375,000. And remember, we have de-risked the portfolio at this point. And you'll see the probability of success goes down to 60%. So it's not certainly not a dire situation, but maybe not the percentage that James and Hannah want to give them that peace of mind. And so what you're seeing here is that the de-risking of the portfolio doesn't provide them enough upside, enough income, enough growth in the portfolio to really cover these additional expenses. And let's remember that these expenses, sometimes um, they're not optional. They are things that happen. This could be healthcare, long-term care scenarios, things like that. And so you might be asking, okay, well, yeah, I mean, what does the 70-30 scenario look like with the increased expenses? Because that's not going to look as well. So if we toggle off the 30-70 and we go back to a 70-30 portfolio, you'll see that it looks better, right? It's 71% successful. Maybe not the maximum green, 80% or above that we really like to see, but it shows that sometimes you do need to take a little bit more risk if you have either plans to spend more or you want to account for possibly spending more.
So it's all about finding that sweet spot between the plan's ability to take risk, a client's willingness to take risk, and then what are we really comfortable with in terms of where we think those spending guardrails need to be in the future. So there's a bit of a Rubik's Cube going on there of how to put those together. Let's take a look at our next question. This one is around gifting. So we talk a lot, especially family-owned businesses, where folks will say, "Hey, is there a way for me to gift a portion of this business to my children? Maybe I want to gift a portion to family or even to a charitable vehicle before a potential sale, well before a potential letter of intent." Um, what does that look like? How do you analyze the ability to gift a portion of a business?
Yeah, I think this is really where you just got to do the analysis. You got to run the numbers, right? So you mentioned a couple things I do want to call out. Whether you're gifting a piece of the business to a family member or to a charity, it could be a donor advised fund, it could be another charitable vehicle. Um, you cannot do that if you have a letter of intent signed already. So sometimes we have situations where uh, there's a letter of intent and we have that ready and they're like, yep, we want to give some to charity. Well, it's a little too late. So this is where the planning piece comes in. If you have run these scenarios already and you kind of know what the guardrails are, you kind of know how much you can gift, then it's really makes that planning a little bit easier. So let's say for the Washingtons, they have two kids, as I mentioned before, and they came to us and they said, you know what, we really want to gift 40% of the business to our kids, 20% each, and they're going to gift it before the sale. So in 2033, they do the gift, and you'll see that the Washington's plan goes down to 71%. So just to reorient you, they've had 9 years of good income from the business. They gifted 40% of the business to their kids, and then they only get to keep 60% of the proceeds and pay the taxes on that as well. And so in that analysis, 71% of their plans were successful. So again, the Washingtons might be very comfortable with this, or it might make them a little bit nervous. So what if let's look at a 20%. What if they gave 10% to their kids? And I think the numbers that you're seeing on the screen would be very similar if this was a charitable gift. The only difference is that on the income tax side, they would be getting a charitable deduction for that gift, which would actually make the numbers look better because your taxes would be lower. But maybe 87% success rate. When we find clients seeing these kind of numbers, it gives them the confidence to be able to make these large decisions. It's really hard to do that without knowing what the numbers are.
And of course, it doesn't mean that just because the numbers say so, that it's a slam dunk. There's many other factors that come into play. But Jason, what I'm hearing from you is you have to start with the numbers. You have to have a baseline for that, and then you can react to it. Because what we see is in the median case, you have $13 million, 13.6 million as your median ending portfolio assets. But that means a lot of that has already been gifted over to the children, and maybe at stages of their life that you're not ready for them to have all of that wealth yet, or you want them to keep working for it, or what does that structure look like? So it's important to recognize this is sort of the step one before you can go down the rabbit hole of all the other more qualitative decision factors that come into play. So let's take a look at our next question. Question number 4 is around liquidity. Is there some sort of rule of thumb for how much our business owners here, the Washingtons, should have in accessible assets, liquid assets over time? So for example, what if the Washingtons didn't have 2 million in those outside assets from the business, but they had 500,000 of assets outside of the business? How would that impact their plan?
Yeah. So as a reminder, they have $2 million in the base plan outside of the business. So the business is worth 6, they have about $2 million. What about if they had 500,000 of portfolio assets and their business was worth 7.5 million? So all we're doing is really shifting the assets from the portfolio into the business. What is the effect of that on their plan? Meaning that instead of distributing out 1.5 million, they decided to keep it in the business. So again, that would affect the value of the business today. It would also affect the sale price. And what you're looking at here on the screen is that scenario. So they have a $500,000 account. And what I draw your attention to is on the far left side, the bars are quite low. They're starting at 500,000 and going up over time. And so our point here is to say that the more portfolio assets you have outside of the business, the more flexibility you have in the event that something could happen. So one thing that we have looked at is, in this scenario, the Washingtons are, they still have their plan of selling the business 10 years from now, but they have a year or several years in a row where either the business income is lower by $100,000 or their living expenses go up by $100,000. So let's take a look at that scenario just on this screen. And I draw your attention to how the left side of the screen, those bars get really, really thin. So those bars represent your portfolio assets. So at the end of the day, it says something like $195,000 in portfolio assets. Um, that that's not a comfortable place to be in the year before you sell your business, right? So our bottom line here, our point is that if you have the ability to distribute money out of your business, this obviously comes with controlling expenses, and there's a lot here, and then starting to diversify your assets. It can provide a really nice layer of flexibility in your plan.
So that's that little bit of protection against a really bad year in the business to say we don't have to feel like we're eating through all of our personal assets or have to dramatically change our lifestyle because we've been sort of saving up that rainy day fund outside of the business value.
Yeah, the other thing I'll bring up too is that it doesn't always have to be a negative thing. Maybe there's an acquisition on the horizon for the business itself, and you need the capital that you would otherwise distribute to yourself for your compensation. And maybe you can lean on your own portfolio assets in a couple years in order to drive growth in the business. So again, it comes to that flexibility and the ability to make that acquisition as opposed to saying, hey, you know what? We really can't afford that because we rely on this cash flow to cover our lifestyle.
I'm smiling because it was just this morning I received an email from a client about a business opportunity, and they said we may need more from the portfolio in the next year or two until this investment really starts to play off. So when you think about the J curve of a normal investment as a business owner, how do you build in that flexibility ahead of time to be able to say yes to the really great thing in the future? So, as we another follow up to this question, how do business owners think through the level of super accessible cash they should have on hand? So, when we look at this plan, we're thinking of that more as investment accounts, long term. It's there if you need it, but you're not really supposed to be touching it. How do you think about the asset base needed to provide that flexibility based on maybe the type of business you're in?
Yeah, this concept that comes up a lot is cash is comfort. So I'll start there. You want to have enough cash on hand to make you comfortable. That is a different number for every client. Some are very happy running things pretty tight, and others want a lot of cash on the sidelines to make them comfortable, to make them sleep well at night. So I think that that's a non-financial aspect. That's more of a mentality of how you think about cash. But in terms of, whether you call them rules of thumb, when you have a business, and especially if it's a one income household and that household relies on that business, maybe you're targeting at least 6 months, if not a full year of expenses in readily available cash is a kind of an ideal thing. And also, what type of business do you have? Is it a very cyclical business? Is it a business that, has really great times and really poor times? Or is it a business with really strong recurring revenues that are more, that have contracts behind them and, very steady income each year? Those might be different answers for different people. So I think it's a combination of what kind of business do you have? What kind of free cash flow is that business kicking off every year? And then what do you expect in the future as well?
Great. So let's dig into our final question. How can business owners think through the exit options that best align with their goals?
Yeah, so the way that we do this is, Holly had a screen up there before about the business owner services, and step one of our business owner services is really diving into the why. So, why did we build this business? Why do we go in every day and really work hard on that? And, what is our ultimate goal here? And I think you have to start there. What are your goals? What are your values? Are you philanthropic? Do you want to transition the business to your family? Um, how do you think about your employees? How do you think about your management team? All of these things weave into each other. So it really starts with a very high level kind of conversation and really documenting, what are your goals as a business owner, layering in the goals of your spouse as well, and other family members, other stakeholders. How do all those things fit together? Because they all matter for in terms of how you transition that business. And all of those different options have different scenarios and upsides. So, one thing that's really important is making sure you build your team of advisors around you to analyze all of these different options. So, you've got to have your CPA involved, right? What is the tax ramifications of each of these options, whether you're talking about an ESOP and an employee stock ownership plan, or you're talking about just an outright sale to a third party or a sale to private equity. What does that look like? What are those tax ramifications, and what are the rules, and how do we plan over time? You need to have that transaction attorney who's done a lot of business transactions. That attorney may or may not be your current business attorney. You might need to seek out somebody who specializes in the M&A world. Maybe you also decide to um, work with a business broker or an investment banker in order to market your business with a broader network. And maybe it creates some demand, some with and there's positives and negatives to each one of these scenarios on the business broker and the investment banker. But who's on that team, and then who's the quarterback, who's really bringing this team together around a table to talk about all of the different scenarios? So I do think the team is really important um, as you're um, as you're working through it. Now, with regards to the Washingtons, let's look at their scenario. They really were interested in taking care of their employees. That was one of their main goals. They said, these people have worked really hard for us for many, many years, and we would like to see a really positive outcome for them as well. So we're willing to say, hey, do we need to get top dollar out of this scenario? Or are we willing to maybe take a little bit less money on the transaction itself, but set up the employees for a longer term uh, uh, goal? And this could look like, the two options that really kind of come to mind there, that could look like a management buyout, but also can look like an employee stock ownership plan or an ESOP. And we're seeing a lot more ESOPs, those transactions happening, especially here in Cincinnati. Apparently, we're a very, very large hotbed for ESOP transactions. We have a lot of family owned businesses and people who really care about their employees. So we're very blessed to be in this area. Um, and so for the Washingtons, they got their advisors around a table and said, let's look at the ESOP. And so ESOPs they are complex. They have other ESOP consultants, but at the end of the day, they said, okay, we can do this, but instead of that $11.7 million transaction in 2034, we're able to get about $8 million. So let's take a look at what that would do to their plan. So this is just a simple purchase price reduction from 11.7 to 8. And you'll see that their plan success is 85%, and they'd still have $13 million left over. So for the Washingtons, this could look very successful to them. They say, hey, you know what? We built this business, and we know that the business is going to survive from here. Maybe James wants to continue in the business for a couple years to really help see this growth through. And so our point of showing this is that you really need to run the numbers in the background to see what are those guardrails? What is the minimum amount that would be successful for you and your family for the long term, and running those numbers and comparing all the different options.
And the other part of that too is even if it's not an ESOP or a management buyout, but instead you go through due diligence and what you thought was going to be 11.7 million, they come in and they have their clipboards and they're marking things down, and all of a sudden that LOI is down to 11 million or 10 million. The beauty of having this plan in advance and knowing those guardrails, as you said, Jason, is folks can say, okay, I still want to sell the business. I don't need top dollar. I don't need to squeeze every last bit of juice out of this lemon. We're very comfortable at a $10 million sale if it means that it's the right option for the business long term, for our family's needs long term, for the employees and our clients. So that optionality is really important to know exactly how far those guardrails can go.
Yeah, I think
So
that I was going to add just one piece to this as well is that we've been talking a lot about sale, we've been talking a lot about transition of the business, but every business owner has a choice each day, and that is to grow or to transition, right? So I want to put a little emphasis on the growth piece as well. So you do have that choice of maybe this process of looking at your business really energizes you to say, you know what, I think we can take this thing to the next level. And that's a fun process too. And really looking at what does that growth of the business look like over the next 10 years? What kind of free cash flow can that business produce over time? How does that fit into your plans for gifting to family and to charity and all of those other things as well? So I didn't want to have the discussion without just mentioning that as as a very key part to working with business owners. It's not all about the sale, it's not all about that transition, it's about the long term and really seeing how do we help our business owner clients accelerate that and optimize their outcome.
today we had a chance to look through 5 great questions. We looked at how to be always prepared to sell your business, how to build in flexibility into a plan, really why you want to engage in these detailed conversations in advance to be able to map out those guardrails, and also some really great points around exit options, but not just exit options, growth options as well, and what that means. So let's go ahead. It looks like we have a little bit of time here and move over to Q&A. We have one question that came in here around timing of returns. So what happens, Jason, if you sell your business and let's just say hypothetically we sold in 2021 when markets were great and business was booming, and we turn around and it's 2022 and interest rates are through the roof and inflation is high and we have a bad stock market and a bad bond market. What do you do?
Yeah, it's a real risk. This is part of the financial planning process. This is part of that plan is contemplating things like that. So that can happen. And it's the same conversation we have with folks who are retiring as well. It's called sequence of return risk is the concept, right? Is those first couple years of returns matter. And you know what else matters is those first couple years of your own expenditures, right? So one concept that we talk to clients about, and we, jokingly, tongue in cheek, is no sudden movements, right? So when you're about to make these decisions, do you need to take all that liquidity and buy the vacation home, buy the boat, buy the vacation home and the boat? Maybe not. Maybe we can take a look at what does it feel like post sale. We've also seen that if people aren't doing the preparation work on the non-financial side of
Yeah.
this transition, that it could be disruptive to the whole process. And so what am I referring to there? I'm saying, what does life look like post sale? What does it look like to not be the owner of this business anymore? Um, have you tied your identity to that business, and what does your identity look like outside? Uh, what do those habits look like? What do those hobbies look like? How is that looking like at home with your spouse? That you're now at home, and your spouse is like, "Oh, you're home now." What does all that look like? It's all important, and the concept here is, how can you practice that while you still own the business? How does that look over time. So I think all of those things are things that you want to be looking at and thinking about. Some of those are financial, like the sequence of return risks. Other of them are very non-financial, kind of what are we going to do together? What does travel look like? What are all these golf, all of those kind of things look like post sale?
So, what is one way that you can practice for the non-financial aspects?
Yeah, it's a great question. One thing that we've seen a lot is a sabbatical program. So the idea here is that the owner takes off a significant amount of time from the business. So that could look like 6 weeks, 8 weeks, even maybe even more to go away. And most of the time they're traveling. I would actually highly recommend that some of the time is not traveling, maybe for that practice piece that
Yeah.
I was talking about before. Maybe do 2 weeks at home without going into the office, but also not traveling to see what that feels like. What does that day look like? But what happens inside the business is that that person is no longer there, right? So how does the business perform without the owner there? It really talks about how closely tied in is the success of the business to the owner, and it can be very enlightening on either side. It could be, wow, we're doing just great. This was, maybe you as the business owner were a little bit of a roadblock to some personal growth of your team. Or it might identify some single points of failure in the business. Hey, we didn't know to move forward because we didn't have you to make that decision. So sabbatical programs, I think, are really powerful.
I just had lunch with a friend who is recently back from her sabbatical and aligned with some needs of her family to take some time away. And she said, no, of course, a few things fell through the cracks that, I forgot that I even did those things and I forgot to tell someone to prep for that. But I did such a good job of preparing the team. We spent about 6 months getting everybody ready for it. That now that I'm back, there's things that I'm not taking back, that it's theirs. And it allows me to really think about, ooh, I have this free time now. What more can we do to grow the business now that I'm back and re energized? So it's not always about just transitioning out. This is a young business owner who has lots of aspirations for growth, and the sabbatical was still a great option. Let's talk about communication, Jason. We have a question here about how do I include my family members in these conversations? And at what point is it appropriate to share the insights and research with important stakeholders along the way?
Yeah, this is a great question. Kind of twofold there. So, family members, again, I'll give my CPA answer, which is it depends. That covers everything. But furthermore, if the think about communication in general, no matter what relationships that you're in, is that if you don't communicate, then folks tend to make up their own truth. They make assumptions and that this is what's happening. So the more communication, the better. But that also doesn't mean that everybody needs to be in the room, right? So if you're contemplating what the next step looks like, you don't really know what that looks like. You're just starting that conversation. Does the whole company need to know that it's up for sale? That could have a lot of drastic ramifications for your business, for your vendors, your customers, things like that. So it is a delicate balance. Overall, I'd say, making sure you have that core team, that your management team should be part of that. Your family members should be a part of that because it does matter. These are the stakeholders in this decision. They may not be the ones who get the final financial windfall, but they're going to be affected by this decision and likely can bring a lot of value to the table if given the opportunity to weigh in on a couple of these factors, and it can be really powerful for the whole outcome.
So, Jason, talk a little bit more about the strategic wealth map and how that can help families align around this idea of the why, the purpose, the values that go into this decision making process.
Yeah, so I mentioned this a little bit before, and up on the screen, you see that the 5 step process. This is really step one, defining your purpose. And our tool is called the Strategic Wealth Map. And think of it as a way to document what your goals and values are as a family. So a lot of our business owners do this for their business. They have their corporate values, they have their mission statement, they have their, their 3-year plan, their 10-year plan, their if they're on EOS, they're talking about rocks, they're talking about all of these things, right? But are we doing that for our family? And do we know what success looks like in our family going forward? The strategic wealth map really helps guide that conversation, looking at values, looking at them between different family members, looking at what's working and what's not working. So in your financial life, what's working, what's not working, looking at the 5 capitals, intellectual capital, and looking at, your health overall. Like, how would you rate yourself? What are these things that are going on outside of just the business and the finances? Are those aligned? And are those in a really great place? Because really taking that self-assessment is a part that really kind of informs steps 2, 3, 4, 5, right? It really, if you start there, you can really understand, like, what are we here for? Is there a real strong philanthropic bend here that we can start doing planning now in order to fill that? And maybe that becomes the what you do after the sale, right? So it's really starting back at square one and taking our clients through that process. It's been really great to have those conversations. And to be frank, whether they're a business owner or whether they're a corporate executive, a doctor, um, that it's a great exercise to go through for all of our clients.
That's great. Well, we will end it there for today's conversation. We wanted to say thank you for all of us joining us here today. We've included our contact information on the screen. Gina Slayton is our newest CEPA at Bartlett, our certified exit planning advisor. We encourage you to reach out to any of us for any follow-up questions, and we look forward to seeing you at one of our strategy update events to come. Thanks so much for joining us.